Markets do not move randomly, but most traders behave as if they do. What looks like chaos on a chart is often just timing, liquidity, and human behavior repeating in structured ways. When traders talk about price, pattern, and time, most people focus only on price. They look at an indicator, maybe a moving average, maybe relative strength, and assume that is the edge. But one signal alone is rarely enough. Markets are auctions, and auctions respond to participation. When participation shifts, behavior shifts. That is where probability begins to change. Intraday, this becomes obvious. The first hour of trading often carries the most forced repositioning, the most information, and the most volatility. Many retail traders avoid it because it feels aggressive. Instead, they enter around midday when volume is lighter and price movement feels calmer. But calm does not equal opportunity. Lower volume often means less momentum, slower resolution, and a higher chance of emotional decision-making. This is where time becomes a variable. Not mystical, not predictive, structural. Time reflects liquidity windows. Liquidity windows reflect behavior, and behavior drives price discovery. When you begin stacking factors, structure, participation, and timing, you are not predicting the future. You are counting votes. Support levels matter more when they align with exhaustion. Breakouts matter more when they align with expanding participation. The more independent confirmations you have, the higher the probability. Now, zoom out to the macro level. The same principle applies. Markets can look stable on the surface, while fragility builds underneath. Breadth can narrow. Credit spreads can begin to widen. Volatility can rise and fail to compress. These are signals of pressure before price fully reflects it. Right now, we assign roughly a 60% probability that late-phase compression behavior persists through mid-2026. We assign roughly a 30% probability that pressure escalates into year-end 2026 through funding or duration stress. And we keep a smaller probability window open for deeper instability into mid-2027 if credit becomes the transmission channel. Notice what that language does. It removes certainty. It replaces conviction with sequencing. We do not need to know what the headline will be. We only need to monitor confirmations versus invalidations. If this probability-driven way of thinking resonates with you, consider subscribing. Not because it helps us, but because it helps you build a structured framework. Instead of reacting to noise, you begin recognizing pressure, sequencing, and confirmation before price forces the lesson. Cycles are not magic. They are constraints repeating. Participation clusters. Liquidity tightens and loosens. Human behavior oscillates between fear and optimism. When we recognize that repetition, we stop trying to forecast every move and start positioning around probabilities. Quick note: this discussion is educational only and not financial advice. We are analyzing signals and regime behavior, not recommending specific trades. In the end, the edge is not prediction. The edge is discipline. Optionality over certainty, confirmation over conviction, and probability over emotion.